Welcome back. This is my 12th update on the viral market crisis. To be quite honest, I don't even know what to call it anymore. But with no further ado, let me get started. Whenever you're in a crisis, when you're feeling uncertain, you try to look for order. And you look for a unifying theory, something that explains everything. I know it's often a hopeless search, but it's worth looking for. So as this market has unfolded, I've kind of isolated the winners and losers because this is a market that has done two things. One is it's rebounded faster than any crisis market that I've seen in my lifetime. And second, along the way, it's enriched some companies and taken away value from others. So for instance, in one of my posts, I noted that growth companies have done much better than value companies. Another one, I noted that young companies have gained value at the expense of older companies. Flexible companies have gained value at the expense of static or rigid ones. So as I look at these winners and losers, I've been looking for what is it that ties them all together. And I think I have one possible answer, and I might be completely wrong. I've been wrong on lots of things. I might be completely wrong on this. But to me, the answer lies in risk capital and how resilient risk capital has been through this crisis. You see, what are you talking about? Well, you're going to find out. So let me start with something that I've done on all of my updates, with an update on markets. So let me start by looking at indices around the world. So if you look at the columns here, you see me break down returns and indices by periods from February 14th to March 20th, which were the dark days for this crisis. Markets were imploding. Between March 20th and May 22nd, a period where markets came back, and a period since March 22nd where there's been consolidation with an upward bias. So if you look across markets, you can see the damage varies widely across the world. The Nasdaq, for instance, your reaction is what crisis? It's up 9% from its levels on February 14th. The crisis has not only not hurt it, along the way the Nasdaq has gained value. The S&P 500 is down, but only 4%. It was down more than 30% at the peak of the crisis, but it's recouped a big chunk of those losses. In fact, that pattern seems to have played out in market after market. If you look at the period between February 14th and March 20th, markets essentially across the world lost value, and since March 20th they've come back, but they've come back to different degrees. We'll come back and talk more about equities, but in those first few weeks, the 3-4 weeks of the crisis, as people panicked, as fear rose to the top, you saw what you almost always see with crisis, a flight to safety. What form did that take? It took the form of people rushing into treasuries. Treasury yields dropped, treasury prices, and across the board you saw the yields drop. Short-term, long-term. In fact, the 3-month yield dropped close to zero. The 10-year dropped from 1.5% down to about 0.7%. Even the 30-year bond was down to 1.25%. That all happened in the first 4 weeks. Since then, treasuries seem to have gone into a coma. In fact, the rates having dropped have stayed low. Along the way, the Fed has acted. The Fed's first action came on March 15th, where they announced they were going to expand quantitative easing, but by the time they made the announcement, rates had already dropped. There was a second announcement that the Fed made, and I'm going to talk a little bit more about this announcement, where they announced that in addition to removing the limit on quantitative easing, infinite quantitative easing, they were also going to take a more active role in the corporate lending market by acting as a backstop in both the corporate bond and the corporate lending market. To me, that was a turning point in this crisis. You don't see that in treasuries, but you do see it in the rest of the markets. I have kept track of commodities, and in particular, I focused on two commodities, oil and copper, both economically sensitive, but both have taken very different pathways. Now, copper is now up relative to where it was on February 14th. So the reaction to the copper market seems to be, what crisis? Oil is down 20%. That sounds bad, but if you remember, at the depths of this crisis, towards the end of March, oil prices were down more than 50%. In fact, there was a day on April 19th where West Texas crude actually dropped below zero because storage space had run out. Now, the two crisis assets I've tracked through this crisis have been gold and Bitcoin. Gold has played its role, at least nominally. It's up since the crisis started, which is what you'd expect during a crisis. It's up more than 10%. There are some gold investors who who believe it should be up even more, who feel that in a crisis there should be even more of a rise. You haven't seen that, but gold at least has held its value. Bitcoin has behaved very much like stocks. Don't take that as a hit against Bitcoin. Bitcoin might have lots of things going for it, but being a crisis asset is clearly not one of them. In fact, in those first few weeks, February 14th to March 20th, when stocks were dropping, Bitcoin was down more than 50%. Since March 20th, when stocks have come back, Bitcoin is up 70%. Overall, Bitcoin is still down, but it's behaved more like risky stocks. So big overview of markets, but as in the previous updates, I think the real data is by looking at individual companies. I've been downloading the data on individual companies every week for the last 18 weeks and looking at the change in market cap week to week. And then I slice and dice the data. I've sliced and diced it in this table based on region. And if you look at the last column, you can see that the most hurt parts of the world, the places in every part of the world, note that you have the same pattern. Stocks dropped dramatically between February 14th and March 20th, and they've come back. But the degree to which they've come back is varied across the world. Globally, stocks are now down about 4%. That's astonishing to think about how much they were down on March 20th. In fact, collectively, global stocks had lost $26 trillion in market cap. By March 20th, they're now down only $3 trillion. In fact, most developed markets have come back, if not entirely to their February 14th level, pretty close to them. The worst hit developed market is the UK. Perhaps Brexit is hanging over their heads, and parts of Southern Europe, France and Italy, are not doing as well as Northern Europe. Overall, though, the worst hit markets have been emerging markets. Latin America, Africa, and India's had a bit of a comeback in the last 3 weeks, but it's still down more than 10%. So the damage is varied across regions. Filed it away. I also sliced the data based on sector. These are S&P sectors. And here, if you look at the last column, you'll notice that the numbers are in red and green. The green numbers are those sectors which have actually come back from their February 14th levels and gone beyond them. So if you look across the 11 sectors that the S&P breaks the market into, 6 of the sectors are now showing positive returns. 5 of the sectors share damages. And let's go through the list. Energy, real estate, and utilities. Big infrastructure companies. Banking is in there because it's kind of it lives in reflected pain or glory. But as we get to July 17th, through which this table is updated, you're already seeing that many of the sectors, the crisis has passed on, at least for the moment. I also broke down the sectors into about 100 industries, and then I listed out the 10 best and the 10 worst industries. The 10 best industries are all now reporting positive returns since February 14th. The crisis has completely passed them by, and the best performing industries tend to be technology companies and healthcare. The worst performing are big infrastructure companies, generally with a lot of debt. So that's the update, and you've seen those updates before. There's not much new that I had to add there. Let's talk about risk capital. What's risk capital? Risk capital is capital that's invested in the riskiest parts of an economy. With private companies, take the form of venture capital, where you're providing capital to young companies, startups. With public companies, it's the money that's invested in the most risky portions of the public market. Young companies, growth companies, money-losing companies, small companies. And if you think about debt, it's a lending that is made to those companies that need it the most, that are in distress, that are in trouble. It's easy to lend money to a safe company. It's more difficult, more risky to lend money to a company that might not pay you back. That's risk capital. And risk capital ebbs and flows. And during market crises, usually, here's what happens. Risk capital leaves the market. Why? Because risk capital is a trade-off between fear and greed. And in good times, the greed beats out the fear. And during crisis, fear tends to dominate and risk capital leaves. What does this mean? During most crises, venture capital shrinks and goes away. There's very little venture capital to be had, which leaves young companies kind of hanging out there without access to capital. In public markets, money leaves the riskiest companies and goes to the safest companies. There's a flight to safety. And in the debt market, you find that companies that are not highly rated, companies that are viewed as distressed, have a tough time raising fresh debt, either from banks or from the corporate bond market. Well, that's an unusual crisis. Let's see how this particular crisis is played out with each of those segments. Let's start with private equity risk capital, which is venture capital. Now, venture capital is essential for economies because it allows startups, which are the riskiest part of the economy. Because remember, 2/3 of startups don't make it, and many startups have no history, no business models. Of course, they're the riskiest segment to invest in. Venture capital's role is to take those companies, nurture them enough that they become viable businesses, and then sell them. Because sell them where? Either in a public market in an initial public offering or to a public company. The fact that risk and return is so much greater in young companies basically means that during a crisis, venture capital often takes on the role of the traditional bird in a coal mine, which is a coal mine. They used to send canaries into coal mines. And coal mines had poisonous gases, the canary wouldn't return. Venture capital is often the front runner when risk capital leads the market. So in most crises, as I said, this is what happens. To provide you an example, this is venture capital funding, in the US and globally, going back between 2007 and 2015 or 2019. Take a look at what happened during 2008, the last big crisis. Venture capital pretty much went away. The number of deals, the amount of money raised, in fact, cumulatively venture capital dropped by 50%. This is new infusions, dropped by 50% in 2008 globally and more than 60% in the US. In a typical crisis, venture capital becomes scarce. You're saying, what's different about this one? I don't know, but in this crisis, venture capital has never quite gone away. There was a brief period at the start of this crisis in February and March where it looked like it might, which explains why the first quarter numbers are lower. But in the second quarter of 2020, venture capital bounced back. It is true that less money is being invested in angel seed, the riskiest of the young companies, and perhaps a little bit more on later stage investments, but the overall amount of money being invested by venture capital is pretty comparable to what it was 4 quarters ago. That usually doesn't happen in a crisis. Now, if in public markets, the role of risk capital is a little more subtle. It shows up first in what kinds of companies gain and lose. And as I said, in most crises, the riskiest companies lose, the safest companies gain. Another place it shows up is when private companies try to go public in initial public offerings. In most crises, initial public offerings shrink or go away. So the question is whether that's happening in this crisis. Again, to give you some perspective, let's start by looking at what I've kind of unveiled in different posts earlier on what kinds of companies are winning or losing. So what you see in this table, and I know it's a little confusing, so I'll take you through some, at least one line item, so you can see what I'm trying to do, is I've taken different groupings and looked at what traditionally would be considered high risk or low risk. So let's take an example. If you take price earnings ratio, generally high PE companies are viewed as riskier than low PE companies. If you look at price to book, high price to book companies are viewed as riskier than low price to book companies. If you look at age, young companies are viewed as riskier than old companies. So that's the categorization that conventional wisdom would lead us to put. So here's what I've tried to do in this table. I've looked at the percentage change in collective market cap in the top decile of each grouping. So let me take you through the PE grouping. The top decile in terms of PE ratios, the stocks with the highest PE ratios over the period of this crisis, February 14th through July 17th, have gained 10.81% or $674 billion in value. So they've gone up in value. The stocks that should be safest, low PE stocks, have seen their values drop by 8.31% or more than $246 billion. In fact, I have 7 categories for riskier. In 6 of the 7 categories, it's the riskier companies that have gained in value, the greens, and the safest companies have lost in value. In fact, the only dimension of risk where this crisis looks like prior crises is debt, where highly indebted companies have been hurt more than lightly indebted companies. On every other dimension, it's the riskiest companies that are gaining at the expense of safe companies. Small companies, young companies, growth companies, high price earnings ratio companies, high price to book, low or no dividends in every single segment. It is the riskiest companies that seem to be gaining. Already you can see that this is a crisis unlike prior ones. Risky companies are gaining at the expense of safe ones. Then I looked at IPOs. Again, to give perspective, I went back and looked at IPOs over time. And take a look at what happened in the last quarter of 2008. In the last quarter of 2008, there's only one IPO. In that last crisis, IPOs ceased to hit the market. In fact, the drought lasted all the way through 2009. In a typical crisis, you don't see very many public offerings. You're saying, what about COVID? Well, in COVID, again, you saw an initial pause right after the crisis hit, where it looked like any conventional crisis. But in the second quarter of 2020, IPOs are back. In fact, there's a pipeline already filling up on companies that are planning to go public over the rest of the year. This too is something you don't typically see in a crisis. Risk capital has stayed in the game. Now, as risk capital stays in the game, the way it shows up in equity markets is in the price of risk in the equity market. You're saying, what are you talking about? My price for risk in the equity market is the equity risk premium, the premium that investors charge for investing in equities. And when risk capital leaves, as it did in 2008, here's what you see. You see the equity risk premium climb. So in 2008, the equity risk premium climbed from 4.3% to almost 7.8%. On November 23rd, it dropped off a little bit, but by the end of the year, it was still well above where it was, almost 2% higher than it was at the start of the crisis. In a typical crisis, equity risk premiums go up and they stay elevated. You're saying, what about the COVID crisis? It's a number I've been tracking every day since February 14th. You've seen earlier iterations of this chart. Let me update you. There's the start, 4.8%. There's the day, March 23rd, where it hit 8%. If I stopped right there, this looks a lot like 2008, right? But it's what's happened since that's different. Equity risk premiums have dropped, and they've dropped almost back to where they were before the crisis. Again, risk capital has stayed in the game. Now, it's not just the US where you've seen this risk capital stay in. In this very difficult to read picture, I computed equity risk premiums for countries around the world. This is something I've been doing for a long time on my website. And I usually do it at the start of the year and the middle of the year. So January 1st, 2020, see the green numbers? Those are my equity risk premium estimates at the start of this year. Markets were buoyant, risk capital was well in the game. Then I redid the numbers on April 1st, almost at the peak of this crisis. Those are the red numbers. Look at how much higher they are. Pick any country you want. Compare the risk premium on April 1st to January 1st. You'll see a tremendous jump in risk premiums. Why? Fear pushes risk capital leaving the market. But then take a look at the blue number, which is my most recent update from July 1st. And what do you see? You're seeing risk premiums come back. They're not quite back to where they were before the crisis, but they're getting closer. So risk capital has not left the market, not just in the US, but across the world. Perhaps it's a little slower to come back in the rest of the world, but it's come back. So that's the equity market. You're saying, what about the debt and the bond markets? In the debt and the bond markets, you have risk capital as well. It usually takes the form of bank loans to the most risky companies, the most distressed companies. In the corporate bond market, it takes the form of bond issuances by companies viewed as riskier, below investment grade. And the absence of risk capital often shows up as much higher default spreads. So in a typical crisis, here's what you see. In 2008, when the crisis hit, corporate bond issuances dropped off, but they dropped off much more dramatically for high yield bonds. See the green? As opposed to regular bonds. So across the board, bond issuance was down. In fact, they stayed down for at least two or 3 years. That was 2008, and that's pretty typical in a crisis. It's very difficult to issue high yield bonds during a crisis because people don't want to take risk. You say, what's different about this crisis? Well, you can take a look at this graph and tell me what's different. This is the issuance of investment grade and high yield bonds by 6-month periods. Take a look at the first 6 months of 2020. 5 of those 6 months are crisis months, right? In June of 2020, high yield bond issuances hit an all-time high. Again, as with equities, you're seeing risk capital stay in the game. And the way this, of course, shows up, as I said, is in the default spreads. In this graph, I've shown you what, I look at corporate bond default spreads by ratings class during the 2008 crisis. And what do you see? You see default spreads climb during the crisis. Risk capital leaves, Default spreads widen. They'll widen more for the lowest rated bonds. That is in a typical crisis. In this crisis, here's what the numbers look like. I have 3 numbers for each rating class. Basically, I look at the default spread on February 14th. Think of that as a pre-crisis spread. Then again on March 20th. Think of that as the peak of the crisis. And again on July 1st. Notice something very interesting. There's a big jump in spreads between February 14th and March 20th. It looks like a conventional crisis, like 2008 again. And then look at how much the spreads have come down. Again, they haven't dropped all the way back to where they were before the crisis, but they're pretty close. As with equity markets, private capital seems to have stayed in the debt markets. The question then is, why? What's different about this crisis? I know many of you already have the answer, right? The Fed did it. After all, this entire turnaround came about after March 23rd. And we know what happened on March 23rd. That was the day the Fed announced that it was going to be a backstop in the corporate lending markets. So the easy answer has been, this is a Fed-engineered comeback. That's too easy. A couple of reasons I'm a little skeptical that this is all Fed all the time. The first is the Fed did make some big number announcements. They announced they were going to spend hundreds of billions of dollars backing up the corporate bond and lending markets. Take a look at this graph because it shows you what the Fed has actually done. Collectively, in the corporate bond market, the Fed has bought less than $10 billion in bonds. If that sounds like a big number, remember the corporate bond market is an $8 to $9 trillion market. $10 billion is penny change. In fact, on almost every single one of the actions other than the paycheck protection, the Fed has done almost nothing in terms of actions. But the Fed's actions clearly work because whatever it did seemed to translate into a big shift in markets. So I started thinking about what else can be added to this mix to explain why risk capital is stayed in. It can't just be the Fed. And I can think of 3 additional factors, and I might not be getting them all, and I'd welcome you to come up with more. The first is I think that the investor composition in markets has changed. In what sense? First, we've all become more global. But also, investors collectively seem to be more willing to move across geographies, move across markets. We're less tunnel visioned than we used to be as much. So investors are more mobile. And that's a good thing for risk taking. Second, the investment world is flattened. I mean, there was a time when if you're a professional money manager or a market strategist, you had access to data that the rest of the world didn't see, tools that the rest of the world could not use. The investment world is much flatter. Retail investors have access to much of the same data and many of the same tools that institutional investors. You're saying, so what? I'll make a statement, and there's no way I can back this up because it's almost impossible to check. If this had been a world where institutional investors were deciding what to invest in and when to invest, my guess is markets wouldn't have come back. Why? Because institutional investors, even though they have access to data and tools, tend to be much more sheep-like in terms of how they behave. They talk to each other, and the fear rubs off across the group. Our investor base is much more diverse. I'm not saying the markets are right or wrong. I'm just saying the investor base has changed, and that contributes to why markets are behaving differently. Second, this crisis is a pretty unique one, right? In most crises, you see a market meltdown first, and then the economy follows. Think about 2008. Market melts down, the economy slows down in 2009 and 2010. In this crisis, the markets were doing really well on February 14th. Then the economy was shut down, the global economy. With the timer, right? I mean, I know the timer doesn't quite hold because they told us that by June we'd all be out there, and that wasn't true. But this is a fairly unusual crisis. The economic shutdown came first, and the markets had to deal with it. Maybe that has something to do with risk capital staying in. And the third, and this is controversial, is that I think the kinds of companies we're investing in today are very different than the kinds of companies we were investing in 50 years ago. I think that, if you look at the biggest companies of the 20th century, tended to be big manufacturing companies that took a long time to build up and essentially were rigid, huge companies. The biggest companies of today, take a look in terms of market cap. Not just in, I mean, I know the conventional view is they invest in intangible assets. It's not that they invest in intangible assets, but they tend to be companies which are capital light that can scale up quickly. But more critically, I think the biggest companies of today are far more flexible. I know that's a word I used in my last post as well, than the companies of yesteryear. Flexible in what sense? They can very quickly take advantage of opportunities and scale down much more quickly than the old companies. You're saying, so what? Flexibility is another word for options. I think there's more optionality when you invest in stocks today than you did 50 years ago. What does that mean? In a sense, with optionality, you get less downside and more upside, which means risk is more likely to be your ally than an enemy. Maybe one reason we're seeing risk capital stay in equities is because of the nature of the companies we're investing in. I know this game is going to continue. We're going to learn more things about markets, but one of the things I would keep an eye on is how risk capital behaves and whether it stays in the game. Because if it stays in the game, no matter what the experts tell you about markets, both equity markets and bond markets are going to be okay. Thank you very much for listening.